I haven't done any sort of research or statistics around it, but 100% it is something I'm looking for as an investor because it marks a very important inflection point for a business. And really what it marks is it goes from being a company reliant on capital markets to being a self-sustaining business. And so you'll often see businesses where if the market is anticipating a capital raise, that share price becomes quite depressed because the market knows that they're about to be tapped on the shoulder for capital, and they want to get as low a price as possible. So when the businesses do make that pivot into profitability, into sustainable cash flows, it means that sort of weight gets lifted off the business and they're able to grow moving forward. And if they do tap the market for capital or even debt as they grow a bit larger, it means they're doing it for the right reasons. It's not for survival of the business, but it's to maybe really chase growth that's there, or expand into a new geography, or look to develop a new product. But what I would call, I guess, a good reason rather than just needing cash in the door to keep the lights on, which, they're the businesses you really want to avoid. The first one I'll talk about is a company called 8Common. The ticker for that is 8CO. So this is a business that does travel and expense management software. And a few years ago, management pivoted to focus on government in Australia as a key client, and have been quite successful in that pivot. And that culminated back in July. They won a contract for the whole of federal government. So a very big contract, a bit of a company-making announcement. But that will progressively roll out over the next 2 or 3 years. And if you model out the federal government employees who will come onto that platform as users and sort of the average revenue that those users bring on, it's a business that will go from doing about 3 million annualized recurring revenue today to maybe around 9 to 10 million in say sort of that 2 or 3 years time frame. And that's sort of exactly what I'm looking for as an investor. I can, with some pretty good degree of certainty, model out the next 2 or 3 years. I can see that growth coming through. And then it's just a matter of the business executing, which I'm comfortable they can. I've sort of been familiar with the business and the management for a few years now, and I think they've executed very well so far, so I back them to continue to do that. So it trades at about that 10 times annualized recurring revenue today, which is probably not cheap, but a fair price, but it's that underlying growth that can come through. So if I think the business can sort of double or triple its ARR over the next couple of years, I think that's where the multi-bagger effect can come from. And the business will most likely swing into profitability in that time as well. It's only slightly loss-making at the minute. So I think with that additional leverage, you'll see that come through in the profits, and you'll get that sort of leverage effect. So that's one that I think if that management team can execute on that opportunity, it could easily be a multi-bagger over that sort of 2 or 3 year time frame. So a second company is called XREF. XF1 is the ticker for that one. So it's another software business. These guys do reference checking software. So it's a very simple platform in a sense where if someone is a subscriber to the XREF platform and they have a new job opening with an applicant, they provide that applicant with the ability to log on to the XREF platform, upload their details, and upload the details of some referees they would like to use for the position they're applying for. Details get sent to those referees. They're able to log on at their own leisure and provide their references, and it's all amalgamated in the one piece of software in the cloud and very streamlined and organised. And it just removes, like a lot of software, removes just the admin burden of phone calls and trying to get people at the right time. Everyone's able to do it at their own time and at their own pace. So simple software, but solves a real problem for HR people who don't want to waste their time making unnecessary phone calls. So the business has done really, really well over the last few years and won some really big blue chip clients and a very good land and expand strategy. But what really excites me about the business is pre-COVID, like a lot of tech companies, they were spending quite heavily for that growth and burning maybe $4 or $5 million cash a year. And I think COVID was a bit of a wake-up call to the management team that if you're going to run those cash losses, the market may not always be there as a provider of capital when you need it most. So swung the business into a sustainable cash flow positive business, and you're really seeing the leverage that you would expect to see in a software business come through. So they've kept their cost base relatively stable. I think from here you'll see some modest cost inflation, but that revenue growth, doing triple digits, admittedly coming off some COVID lows, but triple digit revenue growth is really providing that margin expansion I was sort of referring to before that I always love to see. So top line growth growing very strongly, but it's coming through in the margins as that really leverages over the cost base. And the business is well and truly spitting out cash because their business model means they have a very good working capital cycle where they're getting cash in the door before they even recognise revenue. So That's one where the multiple you're paying isn't cheap. Again, it's probably around that 10 times recurring revenue. So it's not a cheap multiple, but it's where I look at, again, over the next 2 or 3 years, I think the underlying growth of that business will be explosive. And so even if it maintains that multiple or potentially can expand it, you could see a real multi-bagger in that stock as well.